Do you know, last 5 years, CAGR return of equity large cap index is around 11%. Yes, it is despite the pandemic, the war-like situation or inflation or other economic crisis. So this actually makes indices as one of the best investment options as they already consist of chosen large cap companies which gives you the exposure of whole Indian market. And since this portfolio consists of mostly large cap companies, that means the risk is also low. Now, what we observe is that, say for example, the index consists of 50 stocks. So not all those 50 stocks are performing. There are some stocks which are actually pulling the returns upwards, and there are some stocks which are definitely dragging the portfolio down. So if we filter out these stocks which are actually dragging the returns, then it can be a very smart way to invest in indices. We call it SmartNIFTY index. So what happens is we pick a large cap equity index, and then first of all we filter out all the public sector undertaking. What happens is that we believe that public sector entities are meant for welfare of the people and not to generate profits, and that is why for the purpose of investments we do not prefer investing in PSUs, and historically also PSUs haven't performed well. Next is that large cap index consists of numerous companies under a single sector. So what we do is we pick the leaders in those sectors which have the highest growth potential. The next thing is that we check valuation. Not all stocks in the index are undervalued. So that is why we check valuation of each and every company, and we pick up only those stocks which are undervalued at that time. There is no point of investing in quality stocks if they are overvalued. So in this step, we actually remove those stocks which are overvalued from their fundamentals. After that, we check the ESG risk of the stocks. So ESG risks are environmental, social and governmental variables that affect the financial position and operating performance of the company. So amongst these screened out stocks, we now take out the companies which have the lowest ESG risk. Now, if you actually look at it, we picked up a large cap index and filtered out stocks which were underperforming. Then we filtered out stocks which were overvalued, and then we took only stocks which were having the highest growth potential, and then we ended up making a perfectly balanced and diversified portfolio for you. So this portfolio now consists of just 10 to 15 quality picks which are ultimately responsible for pulling up the indices. We also churn the portfolio depending upon the fundamentals of the company, but we also make sure that this churning ratio does not go beyond 20%. Now, if you look into returns since 2020, when this portfolio was created, equity large cap index has given a CAGR of around 23%, while SmartNIFTY index portfolio has given a CAGR of 26%. Isn't it a smarter way to invest in indices?